Hello everyone and welcome back to the channel. We have more crypto related news as well as whale alerts, and there are a lot of whale alerts which we'll cover towards the end of the video. So let's go ahead and get started. Up first, we have 2.5 million RLUSD that was minted at the Treasury. This took place at 6:30 p.m. yesterday. A little bit later at 6:46 p.m. we have 11 million that was minted. Then at 8:19 p.m. 10 million more minted. And then the next day, i.e. today, 5 million more. So back to back to back to back, we've got RLUSD just really hammering it out there. From Steph's Crypto, happening now, White House crypto advisor Patrick Witt says the Clarity Act's main blocker is resolved. So hopefully within the next 2 weeks, maybe as early as the next 24 hours or so, we'll have some really good news. Up next, U.S. oil prices extend losses to nearly down 6% on the day and drop below $94 per barrel. Oil prices are now down 11% since the U.S. military's quote-unquote blockade of the Strait of Hormuz began 24 hours ago. So there's reporting that from President Trump that they're in discussions over the next 2 days. We might see something being resolved with Iran, but you know how those conversations go. We'll have to wait and see if anything actually happens from it. Overall, though, oil prices dropping at the moment. And up next, XRP goes live on Rakuten Wallet April 15th, unlocking 44 million users, 3 trillion plus loyalty points, and over 5 million merchants across Japan. And from Ash Crypto, for everyone that's been waiting for altcoin season, might be getting closer. He goes on to say alt's decision time is very close. Weekly MACD bullish cross has already happened. Now altcoin market cap is trying to break above its 5-month downtrend. A weekly close above the $740 billion level will end the downtrend and could lead to a big rally in alts. US March PPI inflation rises to 4%, its highest since February of 2023. Core PPI inflation was unchanged at 3.8%, also the highest since February of 2023. We are now officially seeing inflation metrics in the US that are at 4% or higher. Inflation is back. Now, the SEC gave clarity that many crypto apps and wallets may not need to register as brokers. This means front ends like websites, apps, and wallet interfaces can keep operating without heavy regulation if they stay neutral. Here's what they must follow. Users must control their own trades. No investment advice or trade recommendations. No pushing users into specific tokens or trades. Only show neutral data like prices, routes, and fees. Fees must be fixed and clearly shown. No holding or controlling user funds. Full transparency on risks, conflicts, and integrations. It protects self-custody and keeps crypto open. XRP Ledger reaches 5 million daily transactions. And stablecoin transactions could soon be tax-free in the United States. This comes as part of the revised Parity Act crypto tax bill. In the case of any sale of a regulated payment stablecoin, no gain or loss shall be recognized on such sale. The bill removes the prior $200 threshold for small crypto transactions and sets a $1 cost basis for certain exchange. And Ripple CEO Brad Garlinghouse says he's still optimistic on the Clarity Act at Semaphore World Economy. Quote, when people are at their peak frustration, that's when they finally compromise and it gets done. I think we're there. I think it's also close. The Fed is now privately preparing for a possible $2 trillion credit market collapse. For the first time in over a decade, the Fed has started directly asking U.S. banks to hand over their exposure numbers to the private credit market. This is the exact move regulators make when they stop trusting public numbers and start preparing for real stress. Bloomberg reported on April 11th that the Fed has formally reached out to major U.S. banks for detailed information on how much risk they're carrying from private credit firms. and whether stress inside that sector could spread into the wider financial system. And here's why this is happening now. Over the past few weeks, 3 of the largest private credit funds in the market have limited investor withdrawals. Blue Owl Capital, they restricted redemptions on its $14 billion fund. BlackRock capped withdrawals on its $26 billion HPS corporate lending. That's the lending fund, after investors requested $1.2 billion in redemptions. And Cliffwater capped withdrawals on its $33 billion fund after investors tried to pull 14% and only 7% was allowed to exit. 3 of the biggest names in the industry, all hitting redemption limits within a short period. That's not random. That's investors trying to get out faster than the funds can return their money. At the same time, Apollo executive John Zito publicly said private equity marks are wrong across the board. He said he literally thinks all the marks are wrong. His estimate, loans to a typical mid-sized software company bought between 2018 and 2022 could recover only 20 to 40 cents on the dollar in a slowdown. That implies losses of 60 to 80%. So, the pattern: investors trying to withdraw from private credit funds, funds blocking those withdrawals, a senior Apollo executive saying valuations across the industry aren't real, the Treasury calling a meeting with insurance regulators this month to discuss the $2 trillion private credit market, the Fed directly asking banks for their exposure numbers. Now, here's why this matters far beyond the US. Private credit has grown to around $2 trillion over the past decade, but it's not isolated. It sits in the middle of the global financial system. Pension funds, insurance companies, sovereign wealth funds, and foreign banks all have money parked in these funds because they were marketed as higher yielding and more stable than public bonds. If valuations are revised down the way Apollo's own executive is suggesting, the losses don't stay with a handful of US firms. They flow directly into public and private pension funds across Europe, Canada, Japan, and the Gulf that allocated heavily to private credit for yield. Insurance companies, some of the largest buyers of private credit whose solvency ratios are tied to these valuations. Banks in the US, Europe, and Asia that lend to the private credit firms themselves, which is exactly what the Fed is now trying to measure. And most people miss this part. A private credit fund limiting withdrawals is not just a problem for that fund. The banks lend to the funds. The funds lend to private equity. Private equity owns thousands of mid-sized companies. Those companies employ millions. When valuations at the top are wrong, the entire chain underneath is mispriced. The exposure also ties directly into the AI infrastructure build-out. Blue Owl alone is behind some of the largest AI infrastructure deals in the world. $27 billion in joint venture with Meta in Louisiana, $15 billion in deal with Crusoe in Texas, and $5 billion backing CoreWeave. Oracle now carries over $100 billion in debt, much tied to AI infrastructure that will take years to generate returns. Companies like CoreWeave, Crusoe, and others are funding their buildouts through private credit rather than public bond markets. The structure works as long as AI revenue grows fast enough to service the debt. If it slows, the stress doesn't stay in tech stocks. It moves straight into the credit side of the system, which is the exact part the Fed is now trying to get a clearer picture of. Globally, this is also colliding with Japan dealing with the weakest yen in decades and rising bond yields, Europe trying to manage weak growth and stretch sovereign balance sheets, China is still working through its own property and local government debt problems, a US consumer already showing signs of strain at the lower end. The world financial system has been running on elevated debt and loose valuations for years. Private credit is one of the largest and least transparent parts of that system. If the valuations are wrong, if redemptions keep accelerating, and if AI revenue assumptions disappoint, losses could cascade through pensions, insurers, and banks across multiple countries at the same time. Fed Chair Jerome Powell said last month he doesn't currently see private credit issues infecting the wider financial system. St. Louis Fed President Alberto Musalem said stress is largely limited to the sector, but the fact the Fed is now pulling exposure numbers directly from banks suggests the central bank wants to verify that for itself rather than take those statements at face value. And this happens when regulators are no longer comfortable being surprised by what they find later. If stress inside this $2 trillion market turns into actual losses, it won't stay inside the US, and it won't stay inside one sector. It will move through pensions, insurers, banks, and AI infrastructure debt across the global system at the same time. Now, that post was quite lengthy. It's very detailed, and I want to give a special shout out to Bull Theory for posting this. So, big thank you at Bull Theory IO. Now, let's go ahead and go over these whale alerts. I'm going to go ahead and go through these quite quickly. There are quite a few of them. So, up first, we have $92 million in Bitcoin that was moved. We have 91 million more Bitcoin moved to Coinbase, $144 million in Bitcoin from Coinbase to unknown wallet, 91.7 million in Bitcoin going back to Coinbase, 102.8 million in USDC that went to Aave from that unknown whale one, $116 million in USDT that went to Bitfinex, 148 million in Bitcoin that went to Binance, $250 million in USDT that went from Bitfinex to the Tether Treasury. Then we have 200 million in USDT from the Treasury back to Bitfinex, 116 million in USDT from Bitfinex to Kraken. We have 150 million USDT from the Tether Treasury to Kraken, 150 million USDT from Kraken to an unknown wallet, 140 million in USDT that went back to Aave. We have 100.9 million in USDC that went from Coinbase Institutional to some unknown wallet, 250 million USDC minted at the Treasury, 150 million Bitcoin from Coinbase being moved out. And then we have 150.8 million Bitcoin from an unknown wallet to Kraken, 150 roughly $1 million in USDC that went from the Treasury to Coinbase, almost 150 million again from Coinbase to an unknown wallet, 250 million USDC minted at the Treasury, 250 million more minted at the Treasury. A lot of USDC going on right there, and that's it for those. Now, taking a quick look at the price movement of XRP, we're sitting at just under $1.37. It did climb up here to $1.39, almost $1.40. You guys can see that level of resistance I've been talking about. Psychologically, the Fibonacci retracement itself, it is really, really close to that. So essentially bouncing off of that, we'll see if it tries to retest it, and I'll keep you guys posted. So if you guys haven't already, you can check me out on Blue Sky at Crypto Atlas. We're at 54 followers, trying to get to 100. And if you want to show extra support, you can find me over on Patreon at Crypto Atlas, or you can become a YouTube member. Thank you guys so much. God bless, and we'll see you in the next video. Peace.